To calculate the gold to silver ratio, the price of gold is divided by the price of silver. That math indicates how many ounces of silver you'd need to buy an ounce of gold. A higher ratio signals that it costs less to buy silver than gold. The average gold to silver ratio since January 1990 has been around 65. This means it would take about 65 ounces of silver to buy 1 ounce of gold. In March of 2020, the ratio surpassed 95, meaning it now takes 95 ounces of silver to buy 1 ounce of gold, though the ratio does fluctuate from day to day. When the gold to silver ratio spikes, it translates into silver being more favored as an asset than gold. When the ratio goes down, gold often becomes the preferred precious metal. As silver prices fall, some folks are shifting their assets around to make room for more silver because the gold to silver ratio has been tilting toward silver, making it more attractive from a price standpoint. Among the factors that can influence the gold to silver ratio are a weaker or stronger US dollar, a rise or fall in interest rates, a slowdown or uptick in economic activity, a pullback or acceleration in global tension. Generally speaking, the ratio increases during times of economic uncertainty. Tracking the ratio can help you pinpoint the right time to buy gold or silver, as it gives you a good sense of when either of these precious metals is considered overpriced or underpriced. However, the gold to silver ratio shouldn't be the only data point you weigh when contemplating gold or silver purchases. Instead, it should be one of several tools you use to guide your decisions. Whether the gold to silver ratio is high or low, you can always call U.S. Money Reserve to discuss the ratio of gold and silver in your precious metals portfolio. And click the link in the description to download your free Gold Information Kit, which will provide you with important information you should know about making any gold, silver, or platinum purchase.